Okay, you've got the idea, you've built a prototype, maybe even signed a few customers, and now it's time to take the leap and raise funding. But wait, how much is your startup worth? What do investors see in your business? And more importantly, are you ready for what's ahead? In this part 1 video to valuation, I'm going to break down the basics of startup valuation from the founder's perspective. I'll explain what investors look for, share real-world examples, and here's the best part. Later in the video, I'll give you some essential valuation guides that can help you set realistic expectations for your startup. So stick around, you won't want to miss it. First up, the founder's perspective on valuation. For founders, startup valuation often feels like a reflection of their dream. After all, you've poured your heart into this idea, sleepless nights, lots of personal savings. This is your baby. So it's easy to believe your startup should be worth millions from the get-go. But here's the reality. The numbers don't lie, and the investors won't either. Valuation is not about how much effort you've put in, it's about the potential value your company could create. Let me give you an example. Sarah has a health tech app that helps people track and manage chronic conditions. She spent a year building it. She's already got 1,000 active users. She's convinced her startup is worth $2 million because, well, that's what her gut tells her. But investors, they see things differently. Here's the wake-up call. Sarah's valuation isn't based on what she feels it's worth. It's based on market data, user growth, revenue potential, and the size of the problem she's solving, or the potential. From Sarah's perspective, it's about her passion. But from the investor's perspective, it's about returns. So what are investors looking for when they evaluate your startup? I first want to address market opportunity. Is the market big enough? Investors want to know if your product addresses a real and scalable opportunity. If you're solving a niche problem for a tiny audience, that might be fine, but it's not what most investors are looking for. So next up is traction. This is proof that people actually want your product. It could be users, revenue, or partnerships. Early stage investors know your startup won't have all the answers, but they need evidence that you're onto something big. Let's talk about the team. It's often more important than the product itself. Investors bet on people, not ideas. They want to know, are you resilient? Do you have the skills to adapt when things inevitably go sideways? So when I do these videos or teach the subject of valuation, people generally want valuation guides. So let's talk some numbers. What kind of valuation can you realistically expect as a startup founder in, let's say, the US or the UK? If you're pre-revenue and at the proof of concept stage, valuations tend to fall between $500,000 and $3 million in the US. In the UK, the range is slightly lower. It's between £250,000 to $1.5 million. At this stage, investors are mostly looking at the idea, market potential, and team. Now, if you've moved past the proof of concept and you've gained some traction, and let's say your product has 1,000 paying customers, that will vary on the industry or whether it's enterprise or whether it's end consumer, but your valuation could jump significantly. In the US, startups with this level of early traction might see valuations between $3 to $10 million. In the UK, it's a little lower, it's between 1.5 and £5 million. Of course, these numbers vary depending on your industry, growth metrics, and the broader funding environment, but they provide a good benchmark for setting realistic expectations. Here's the balancing act every founder faces. You need to believe in your vision enough to inspire investors, but stay grounded enough to face the realities of valuation. A common mistake is overvaluing your startup during the early funding rounds. You might think a higher valuation is better. It feels like validation. But if you overpromise and underdeliver, you could struggle to raise future funding. And trust me, you don't want that. On the flip side, don't undervalue yourself either. Selling too much equity early on can limit your flexibility in future rounds. The goal is to find a valuation that reflects your progress and potential while leaving room to grow. So if you're a founder, here's the truth. Startup valuation isn't just a number. It's a reflection of your story, your market, and your ability to execute. And guess what? Investors want you to succeed. They're not just writing checks, they're betting on your vision. So yes, the valuation process can be a wake-up call, but it's also an opportunity. It's a chance to sharpen your pitch, refine your business, and prove to yourself and to the world that you're ready to play at the next level. Remember, every unicorn out there started with a founder who believed in their idea, but also understood the game. So dream big, but stay smart. That's how you turn vision into valuation. Thanks for watching. If this video resonated with you, hit that like button, subscribe for more startup insights, and drop a comment below about your own funding journey or challenges. Until the next video.